So section 1 is defining market structure. My definition is a sequence of proximate highs and lows in a given instrument, and that sequence varies depending on whether the market is bullish or bearish. For bullish market structure, we generally expect to see higher highs and higher lows. For bearish market structure, we generally expect to see lower highs and lower lows. This begs the question, which highs and lows, as there are many, are suitable anchors for ascertaining market structure? Generally, and as you may remember from the Fib video, we give significance to swing highs and swing lows for market structure anchors. They can be defined in the following manner. A swing low is a low with a higher low on both sides, and a swing high is a high with a lower high on both sides. So a low sandwiched by higher lows, and a high sandwiched by lower highs, if you will. There's no single formula, in my opinion, for choosing which highs and lows are valid for market structure. There are a number of factors to consider when it comes to arriving to the decision of what's a valid swing high or low to choose. Here are some you might want to consider. Recency is important. Significance and size of the move following that high or low is important. Again, revisiting the concept or the principle of greater clarity leading to better outcomes. If you have a bigger, more significant swing away from the level, it's probably going to be better and more significant and meaningful generally for your trading as well. The basic smell test, of course, is what's the most obvious or outstanding high or low. You probably can't go wrong with that. And if it doesn't look like a clear swing point from first glance, it likely won't be the best structure. So again, going for the so-called low-hanging fruit is actually pretty wise when it comes to this type of technical trading. As to the question whether market structure and trend are the same, I would say they're not. They're somewhat complementary and can be used in a similar fashion. I don't think you need to pick between one or the other, and I don't even think they conflict a lot of the time. So for example, you may have a high time frame bull trend, which sees a low time frame market structure break, and it's not like you have to pick which one is correct. They both provide different types of contexts, and in that case, with the low time frame breakdown in a high time frame uptrend, that could just lead you to the conclusion of a potential opportunity to buy a dip. Here's the diagram version of the swing high and swing low. As you'll recall, swing high, lower high on both sides, swing low, higher low on both sides. This should say higher low, not high low, but it's been one of those days. We talked a lot about filtering swing highs and swing lows. Even if we just take the basic definition of low with a higher low on either side, high with a lower high on either side, with the daily time frame chart, which is supposed to be the cleaner, slower moving one, this is my quick markup of the swing highs and lows using that definition. There's a lot going on. If you were to draw levels on every single one of these highs and lows, it wouldn't be the most useful and actionable chart in the world, even though it is pretty high time frame. You can only imagine what an intraday chart would look like, which is why, in my opinion, it's important to continue paying attention to these considerations for choosing highs and lows, as opposed to just blanketly selecting all of them. I think some selectivity and some sort of quality filter is definitely helpful and will make things more actionable. So some further things to consider. Is the swing high or low you're assessing confluent with another key level? Is there more going on at that level that will attract the attention of further participants? Is it a nice support resistance level with multiple touches? Is there a candle open there, like the monthly open, weekly open, daily open, etc.? Is there just a good reason to have eyes there? As was betrayed by the previous chart with all those nice arrows, in any given market on any given time frame, you can almost certainly find structure that qualifies as an MSB. That in itself does not make it worth trading. And that is the reason why we have those quality filters, so that when we have higher highs and higher lows, or just market structure levels more generally, that they actually mean something, as opposed to having a ton of overlapping levels generating a lot of noise and very few signals. As for further quality filters, if in doubt, SR it out works quite well. So by definition, horizontal support resistance is derived from old highs and lows. If you can identify at least decent levels, so you've got some prowess in support resistance identification, you can automatically identify meaningful market structure levels, or at least your job is easier. It also works for trend lines, given the sequence of higher lows and lower highs. those make up your uptrend and downtrend line levels as well. So if you've got a nice trend line and it's broken, good chance you've got a market structure break on your hands as well. The more eyes, the better. A quick note on candle bodies for market structure. Bit weird, but something I use, so I get questions about, and people generally love the topics of wicks and bodies. So it's unconventional, but I personally use them. I find they work better on high time frames and or at swing points, where the wick may make things a bit difficult or some sort of outlier. I'd just say test for yourself and be consistent. There's no right or wrong way, in my opinion, as long as you're not forcing narratives on the chart and being selective based on other biases. So we had this chart earlier with every single swing high and low, and then this version is maybe the higher quality or filtered one, where I've opted to choose the swing highs and lows that I think are really outstanding and significant on the daily time frame. And as you can tell, there's just more room between levels, easier to read, and that tends to translate into more actionable ideas and signals also. You can do this exercise yourself. Pick any market, any time frame, maybe something you've never looked at where you don't trade, and just delineate using, again, the basic definition of swing high and swing low, what you think are the clearest or most outstanding levels that are available. Unlike most things, I found that the less you think about this, the better the results, and of course with time and practice, it'll become second nature. Still on defining market structure, difficult question. Is there a single unified market structure per time frame? We can compare this to trend. Let's say the 200 daily moving average is your key for directional bias. In most cases, unless the market's just chopping up the level or it's really close, whatever, but in most cases you'll be able to look at where price is relative to that 200 daily moving average, and it will give you a pretty unambiguous answer as to whether the market's bullish or bearish. If it's above it, it's bullish. If it's below it, it's bearish, right? I think market structure doesn't lend itself well to that type of uniformity, which isn't a bad thing. I think the assessment or your assessment of market structure will depend on how strictly you define your criteria for valid swing points, and that will of course affect the types of trades you want to take. So let's say you're on the looser side of the spectrum and you just map every single swing high and swing low as in this example chart, then you will have many types, many market structures going on at the same time, depending on which swings you're paying attention to, and then you'll have short-term breakdowns, but longer-term higher lows, etc., etc. Whereas if you're more on this side of the spectrum, where you're conservative and far more selective about the swing highs and lows that you choose, you may get fewer market structure signals going on at any one time. But even if you have the cleaner daily view, you could have shorter time frame daily market structure breaks, even if your daily market structure levels are intact. So again, it's a bit of a mixed pot, and I think it really depends. I don't think there's one market structure. It just depends on how strict you are with your guidelines. The stricter you are, the less noise you will have, so maybe less going on at the same time. But if you're very strict with this is my market structure level and everything else is noise, then maybe at times you will have a clear read as to this is the market structure on a given time frame. I just don't think it's a totally useful way of thinking about things. So for example, it's totally fine to say that high time frame market structure is bullish, but the low time frame market structure has been broken, even on the same time frame. So if you look at a chart and you think, well, yeah, you've got a higher low here, but this is a lower low, and oh my god, do I have to pick and choose? The answer is not really. The third point is pretty important. It'll become apparent as we continue more in discussing setups and identifying market structure breaks, but do not chase every market structure break. This is something to have in the back of your mind as we go further into the content. If you end up ascribing significance to every single shift in market structure, you are turning yourself into nothing more than a breakout and breakdown chaser. If that's your strategy, fine, but it's got very little to do with how we want to use market structure as a tool to provide context and maybe derive some setups as well. I mean, by definition, even if you have like a bullish dip or a higher low, that implies that market structure was broken on some time frame to make price go lower, and vice versa. So if you're always like a cat chasing a dog chasing its own tail type of thing, and pretending you're doing so under the guise of market structure, it's generally not going to lead to the most amazing outcomes.